Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, Alphabet. Those shares are falling this morning after the Google parent announced massive spending plans. The company planning to dish out $185 billion to build out its AI infrastructure this year. 2026 spending totals more than the last 3 years of spending combined. And investors will now look to Amazon results after the bell for its plans on AI expenditures. Plus, Bitcoin falling below $70,000 per token, its lowest level in 15 months. The cryptocurrency is now down 44% since its record high in October, and overall $1.7 trillion has been wiped from crypto assets. Despite a pro-crypto White House, don't expect any intervention. Before the House Financial Services Committee, Treasury Secretary Scott Bessent indicated the government would not bail out crypto, whatever that would even mean. And silver is plunging after 2 days of back-to-back gains. The precious metal sunk by 17% at one point as the commodity tries to find a floor amid the market rout. The record run in silver and gold unraveled last week amid a rebound in the U.S. dollar. Let's get a check in on stock futures right now. We've got selling pressure across the board here today. So yesterday there was a bit of a divergence with the Dow performing better, the NASDAQ doing worse. Today, all three are indicating a drop at the open, although there's still a divergence. But the Dow is negative, indicating a drop of nearly 170 points at the open. The S&P 500 pointing to a decline of about 0.6%. NASDAQ 100 futures down the most, about 0.75%. And that is because, at least primarily, or at least in part, because of Google, the Alphabet, the Google parent, falling after saying it plans to nearly double its spending this year. The company reporting CapEx spend in the range of $175 billion to $185 billion. As CEO Sundar Pichai says, AI investments are driving revenue and growth across the board. Joining me now, John Blackledge, TD Cowen Managing Director and Senior Equity Research Analyst. So, John, what is the difference between a company that announces huge spending plans and the stock rises, and one that announces huge spending plans and the stock falls?
Yeah, Julie, the gap there is expectations. And so, like you referenced, at the midpoint of their CapEx guide, $180 billion, double last year. We had been forecasting $125 billion. Sell-side consensus was $115 billion. And I felt like just in our investor conversations leading into earnings, investors were around $130 billion. And so it's actually, it's a pretty big gap. And so I think investors today are digesting, one, this guide on CapEx, but also with it, and what you just led with, this cloud revenue acceleration was massive. So you are seeing the AI demand and investments in cloud, search growth accelerated. And Sundar also mentioned that, there are capacity constraints still, just given the strong demand at cloud, at search, et cetera, for the strong AI demand. And so, they're going to double CapEx, and they also said, like, even despite doubling CapEx this year, they're still going to be constrained entering next year. So that just gives you an idea of just how much demand there is for their AI, AI offerings.
So it sounds like you think that maybe the sell-off is a bit of an opportunity for investors to step in, or that it's sort of misguided?
For sure. I mean, yeah, it's looking down 4 to 5% today. And let's, to be fair, the shares are up 60% over the past year. Sure. So, for us, I mean, if you look at Alphabet, I mean, they have arguably now the leading foundation suite models with their Gemini suite of models, which is driving, kind of like I just referenced, the cloud growth and all the opportunities there. And then, like, if you look at search, right, their core business, search growth accelerated by a couple points, beat street estimates. It was broad-based across verticals, across geos, and they said that AI mode and AI overviews drove record engagement at search, which is pretty historic. And if you go back over the last year, I mean, Alphabet's done an incredible job, with its Gemini suite of models, B, incorporating AI tools like AI mode and AI overviews into the kind of broader search umbrella, and really kind of stave off that sentiment that was out there the last couple of years of ChatGPT being a big secular risk to Google search. And so, from that perspective, we're entering the year for Google. Their businesses, search and cloud, are in really good shape. They're accelerating. So, it may take a step back today, but I think the story is like over the next couple of years, still a great story.
To your point about Gemini, I thought the numbers were interesting there. That 750 million monthly active users on the Gemini app, which of course doesn't capture desktop or people going to a browser, I suppose, and using it. And then they said they had, 8 million paid users on Gemini Enterprise, which was also interesting. How do you think about Gemini as the engine for some of those other things that you were talking about, and sort of how the consumer-facing users on the app or wherever then feed into the enterprise flywheel too?
Oh yeah, no, it's the Gemini 3, Sundar was talking about it last night, how great of a model it is. And you're right, like you're seeing it in the enterprise. Yeah, the 750 million on the consumer side, 750 million MAUs, that was up from 650 million at the third quarter. And they said engagement is also rising in the standalone Gemini app. They also called out the Apple relationship and how they're partnering there, and how this is from the enterprise perspective. Apple's going to be building their foundation models off of Gemini and off the Gemini suite of models. So it creates, when you have kind of leading tech like this, leading foundation models, it creates incredible optionality for Alphabet, both on the enterprise side and on the consumer side.
The other thing I wanted to ask you about was a comment that the CFO made on the call, that the AI agents are writing about 50% of Google's code at this point. I mean, do you anticipate a big wave of job cuts at some place like Google if that is indeed the case, that they're just not going to need as many people to do coding there?
I don't think so. And you had some headcount growth. We're past the days of like right after COVID where these companies were adding a crazy amount of employees. And I think you've seen, well, you saw it with Amazon, they're obviously cutting, but I think for Alphabet we have modest headcount growth. And one of the benefits of this technology is the productivity gains. But if you go back to the Meta earnings last week, I think their CFO said, this was in the callback. She said, "Yeah, we're seeing productivity gains with our engineers." And someone asked if they would cut heads, and they're like, "We actually may add more. More great technical workers that are more productive can kind of drive their business." And I don't, so I don't see Alphabet with broad headcount cuts to come, but headcount growth has slowed definitely, obviously, over the last couple of years.
Right, and we got Challenger Grain Christmas numbers this morning showing lots of job cut announcements in the month of January. I wanted to ask about Waymo and its role here too. Of course, it was in the other bets part of it, right? So yeah. Again, like when you think about these things that sort of seem like side businesses for Alphabet, of which it has many, how do you think about what it means to the business?
Yeah, I mean, Waymo, I think they're raising at like $110 billion valuation. It's still a really small part of the overall Alphabet valuation. But I mean, they're the leading AV tech, full stop, in the United States. They're in 6 markets now. They just launched in Miami, I think, last week. We think they're going to be in upwards of 20 markets in the US and London and perhaps even Tokyo by the end of this year. They're definitely accelerating their roadmap. And it's been a long-term investment, and that's what Alphabet does. They bet on the long term. And so over the next 5 to 10 years, Waymo is going to be increased. We're going to increasingly see Waymo, in the U.S. and outside the U.S. Definitely a part of the rideshare industry. I also cover Uber and Lyft, and then we'll see how it evolves and if it becomes if they partner with OEMs and kind of the technology is on the autonomous technologies on vehicles that consumers can buy.
Finally, I do want to get your take, John, because obviously you're positive on Alphabet. We're seeing the shares under pressure today, but this is happening amidst the backdrop of a bigger tech sell-off, right? Yes, a lot of it's concentrated in software, but it has gone well beyond software at this point. What do you think that reflects? How far do you think it could potentially go? And what's going to regain the confidence of the market in some of these names?
Yeah, I mean, I always go back to, kind of execution. We're going to have to look at execution, and we're going to get Amazon tonight. I also think it should be good, and we're bullish. We're bullish on Amazon, but I think it would be the companies executing and proving out that there are returns for these AI investments, and work on the part of folks like myself and my peers and investors on figuring out the returns for this really historic AI infrastructure investment cycle that we're in. Yeah, I don't know in the near term if the tech tape is gonna turn up, but I think you're seeing like the fundamentals for these companies are really in great shape. Obviously, we've talked about Alphabet. Meta's fundamentals are very good. And we think Amazon's are as well. We don't cover Microsoft and some of the other players, but yeah, so we'll have to see. But yeah, execute and kind of follow their plans.
We shall see what ends up happening. We know they have big plans, that's for sure. John, thanks a lot. Appreciate it.
Thank you.
Coming up on Morning Brief, we'll talk today's top trending tickers and the rotation that we have seen in the market. Plus, you can tune in to Opening Bid at 9:45. Brian Sozzi is going to be talking to the CEO of Elf Beauty as that company shares soar following its strong outlook. Now time for some of today's trending tickers. We are watching crypto stocks, Estee Lauder, and ConocoPhillips. First up, crypto stocks and strategy in particular. The cohort's under pressure as Bitcoin falls below $70,000 per token. Meanwhile, Michael Saylor's strategy is near the top of the Yahoo Finance trending tickers page because the company, of course, has gone all in on Bitcoin. Strategy is the world's largest Bitcoin treasury company, owning more than 3% of all Bitcoin in existence. As of its latest Bitcoin buy, the company's average purchase price is $76,000. The stock is now trading nearly 72% below its 52-week high and has traditionally traded at a premium to Bitcoin, but that does not seem to be the case any longer. Next up, Estee Lauder shares falling after its outlook cast doubt on the company's turnaround. The midpoint of its earnings outlook came in below analyst estimates. Estee Lauder did narrowly beat Wall Street's expectations for revenue and adjusted earnings per share in its most recent quarter. The stock had surged more than 80% over the past 12 months on optimism over its strategy under its new CEO who took over last year. And finally, ConocoPhillips, the oil giant's earnings fell short of expectations amid the impact of lower oil prices. The company forecast a cut to its crude production this year amid the slump in oil prices. It plans to cut capital and operating costs by $1 billion this year amid the drop in oil prices. Well, U.S. futures are lower as investors digest this week's tech sell-off. Joining us now, Angelo Kourkafas. He's a senior global investment strategist at Edward Jones. Angelo, we have seen this tech sell-off, and we have also seen a rotation into lots of other stuff, sort of cyclicals, old economy kind of names. Do you expect that sort of movement to continue? Do you think tech will continue to be under pressure?
Yeah, I think rotation remains a dominant theme for markets this year as we think about investors rotating into what I would call old economy sectors and stocks, whether that is transports, regional banks, chemicals, oil and gas. And I think there is a good reason for that. And this week's rise in PMI, looking at manufacturing activity, expanded at the fastest pace in over 3 years. So there is hope that we're seeing a turn in the industrial cycle after a long period of stagnation. I think that provides some promise. And this is happening at the same time as the momentum moves away from some of the more growthy, speculative parts of the market. So I think this is a healthy development and potentially has some legs.
Well, I guess, Angelo, the problem is it's a healthy development, maybe, but like the market can't rally without tech, I guess is the issue. I mean, there was a note that Julie and Emmanuel over at Evercore ISI came out with that pointed that out, you know, that we've got between tech, communication services, and consumer discretionary, which has Amazon in it, that's 54% of the S&P 500. So if that stuff is not going up, the S&P can't go up. So how do you think about, you know, the rotation being healthy without, you know, tech kind of has to participate, doesn't it?
Yeah, that issue of high concentration is the reason why we see the equal weighted S&P outperforming the market capitalization S&P. Small caps, mid caps are outperforming. The reason why I call it healthy is that while technology stocks continue to deliver strong earnings and results, what that has translated into is basically earnings rising faster than prices and valuations getting cheaper. It's been more than a year that the technology sector has not seen valuation expansion. So at some point, there's going to be some bargains, and technology remains one of the key drivers, really, for the earnings growth for the S&P. But now, there is an alternative, meaning that before there was no earnings growth from the rest of the market, and there is one now. I don't think, you know, this decline in technology stocks is going to be becoming something deeper necessarily, but it is a dynamic that we are watching. We have seen indiscriminate selling in software stocks. And at some point, there's going to be some winners and some losers. Not all of these software stocks are going to be disrupted by AI. It is hard to now differentiate who are going to be the winners, who the losers. So participating and looking for some bargains in a diversified way makes a lot of sense. So we don't think tech is going away, but there is some positive thrust for parts of the market that have been unloved for a long time.
I mean, they've been a lot more loved this year, at least some of those groups, right? Energy has certainly done well this year. Industrial is doing pretty well this year. Is there one or two of those groups in particular that you think is especially well poised to continue to outperform this year?
We like industrials. The industrial sector has very different end markets that are all participating in the industrial upcycle. We also like consumer discretionary. In the first half of this year, we're going to see some of the tax refunds benefit and support consumer spending. And then we also like healthcare as a sector that has been out of favor and potentially has some upside. So we're not recommending to underweight tech, but we are spreading out some of our exposures, and we see that cyclical upturn acceleration benefiting sectors like industrials.
Angelo, what do you think about the sort of macro backdrop here? Because traditionally, a sector like industrials or some of the other cyclicals would be doing well because there is an expanding economy. But at the same time, yes, we saw strong GDP growth late last year, but we're in this sort of sluggish labor market. Do you think that is going to start to be reflected in growth as the year goes on?
Yeah, I think the low hiring, low firing conditions in the labor market will probably persist. But at the same time, corporate profits are rising. We are seeing above trend growth. And it's not only AI CapEx spending driven. It has been the consumer really pushing this economy higher. And that is the key reason behind the resilience. We're talking about a slowdown, no doubt a cooling in the labor market, but incomes remain supported by rising wages that outpace inflation. So even though necessarily we have seen the so-called K-shaped economy with the high income cohorts doing a lot better and accounting for most of the spending, at the same time we don't see any catalysts, either looking at companies that remain very profitable, they don't have necessarily a reason to really provide grand scale layoffs, or at the same time we have multiple levers in the economy that are starting to work, including the industrial and manufacturing side that has been in, let's call it, recession most for the past 3 years.
And then I know you, like many investors now, are looking outside of the U.S. as well, right? I mean, that trade has had a bit of a run already, but it feels like people are kind of sticking with it.
Yes, we think about one of the most lasting drivers of returns being earnings. We are seeing an earnings acceleration outside of the US, similar to the industrials here in the US, where we have seen really manufacturing sluggish environment for the past 3 years. That's been the case also abroad for other indices. And now that is starting a bit to change. The US dollar weakness has been a key driver behind the outperformance, but it's not the only one. And we are looking for a potentially range-bound to slightly weaker dollar, which should continue to benefit those international asset classes. And as we talk about tech, we still have many AI companies that are located abroad and are still part of that AI build-out story that trade at lower valuations. So I think there are some credible reasons for international diversification to really be a key part of investors' portfolios this year.
Yeah, and certainly that has been working well. Angelo, thank you. Appreciate it.
Thank you.
Coming up on Yahoo Finance is Opening Bid. Executive editor Brian Sozzi is with us now. Soz, what's coming up?
Oh, you darn right, Julie. I'm with you. And I just put this out on X. I'm blasting 2 tech companies right off the jump here. Didn't like their quarters, didn't like their guidance. They really put me in a bad mood. One company that did not put me in a bad mood, Julie, that is Alphabet. Love the quarter, love the earnings call.
Oh, wow. I got to go over and see what those 2 are that put
I think you should, because I'm deleting that post on X in about 2 minutes after I go live. Can't let that stuff linger, Julie.
You gotta go into the show with positivity.
I'm always
love,
positive.
Great energy.
I always have that, Julie.
Okay, if
Always.
you say so. All right, thanks, Soz. All right, keep it right here. Opening Bid is next.